Hello, everybody. Welcome to the Dennis Money Show. This is a slightly different episode, Taylor. This is our first ever emergency podcast, right?
This is an exciting day for Jake and I. For those of you that don't know, we're avid Bill Simmons listeners. And if you
Yes.
don't know who that is, he's just a very famous sports podcaster. And he does a lot of emergency pods throughout the year when there's a big trade or there's a big game or something happens. And it's always a treat because he already does 3 2-hour long form podcasts a week, which I listen to every second of. And the emergency pod is just an additional pod that I get on top of it. So this is
So
our
we are
version.
here. We're taking up the mantle. We are not talking about Giannis possibly being traded from the Bucks, but we are talking about the new tax bill that was recently passed. Trump's, what is it called, Taylor? One big beautiful bill.
One
I
big
always get
beautiful
confused.
bill, triple B's.
I can't believe we're calling it that. Yes, but the tax bill that was signed into law July 4th, right? So last weekend, I think, is when it was officially passed. There's been a lot of fallout from that. What we are going to focus on specifically today is the student loan portion of it. I'm sure we'll have podcasts down the road talking about the other details, maybe the no taxes on tips or different things like that. But today we want to focus on student loans. We feel like that is the most urgent and pressing need and biggest changes for the client, for our clients.
Yeah. What really prompted this, Jake, was not necessarily the bill itself, but the Department of Education came out either today or yesterday. I mean, it was really within the last day, and they've made some changes to the new or to the Save plan, which a lot of people are on and have been in a waiting period with this forbearance. And instead of what they said initially at the beginning of the year, which was, hey, nothing's going to change until at least the end of the year, they completely changed their mind and said, hey, not only is it not changing until the end of the year, it's actually changing 3 weeks from now. So the big update that's happening, and the reason why we wanted to get this out is the new save plan that a lot of people are enrolled in, interest is going to start accruing under that plan starting August 1st.
Yes, that is why we are doing this podcast. That's the timeline that makes things a little bit urgent here. I want to back up one step. That was the teaser, perfect teaser. Back up one step and to say we are recording this podcast, Taylor and I, on Thursday, July 10th in the afternoon, kind of in the evening here. We usually don't like to timestamp our podcast, but I feel like this is an important one because you may be listening to this and four other news items may have come out that can change what we've talked about here. So I want to timestamp it. We want to get ahead of this and try and prepare everybody who listens. But as with all of this stuff, it's a moving target right now. They passed this bill that had all these different line items about here's what's going to happen to student loans. And I think we are still in the early stages of figuring out logistically how all of this is going to work. So what we're going to talk about today is what we know now. Again, this may change a little bit in the future, but this is just brief synopsis, what changes happened, what we know now. If things materially change, we'll hop on another podcast, but I just wanted to timestamp that before we hop in. Is that fair?
Yes, that's a good
Yeah.
point because really we don't know and they don't know like the logistics of everything and how this is going to fall out. There's just not a lot of answers. But despite that, they've already indicated that the servicers are going to be reaching out soon. If you haven't gotten an email yet, you will get one soon. If you're on the Save plan, and it's going to urge you to switch plans. And it's urging you to switch plans with very limited information. So Jake and I's hope on this podcast is to help give a little bit of background and just give you a little bit of insight as to what you might change to based on the
Yeah.
information we know now.
Okay, well, let's start here. I think we've done enough preamble. Well, we're 4 minutes or so in here, but let's get into some of the details. You already mentioned one with the August 1st deadline. Let's start with the save plan. I think that's the best place to start. So for some small backstory, under the Biden administration, they implemented what's called the SAVE plan, the Saving on a Valuable Education. You know what I was thinking about, Taylor? Sorry, quick tangent here. I wonder whose job it is to come up with the acronyms for these student loan repayment plans. Do you think someone is like, their job is, hey, we're doing this new plan. You need to come up with the acronym for it.
Yeah, I don't know if you're a Parks and Rec fan,
I
Jake.
am. Yeah.
It
Yeah.
literally makes me think there is like an actual Leslie Nope out there coming up with these acronyms, and it's just so pleased with themselves because it feels like a Parks and Rec episode.
Okay, so coming back here from that tangent, we have the SAVE plan that Biden instituted. This is a really cool plan. It gave an interest subsidy. It gave you kind of this payment calculator. You have an interest subsidy and things there. Anyway, the SAVE plan is going away under this new bill that was just passed. We thought that it might. We tried to prepare people that, the SAVE plan has been in administrative forbearance for a year, Taylor?
Since June of 2024.
Since June of 2024. So everyone who was on the SAVE plan, your payments were paused or frozen. You weren't making any payments. The benefit of this for a lot of dentists is you didn't have any payments, but no interest was accruing on these loans. So you've been in a bit of a holding period. It wasn't a bad thing. We were kind of just waiting to see what was happening. Our initial idea was we were going to get more clarity this fall, right? September, October range of what might happen with the SAVE plan. I think we've gotten a little bit of clarity earlier, which is why we're hopping on this pod. Things have happened a little bit more quickly, but the SAVE plan is going away under this new bill. And we'll keep talking about this throughout this podcast. But as of now, the deadline to get out of the SAVE plan is July 1st, 2028. Right, Taylor? Did I misspeak on anything there?
No, that's correct. And it's not only the SAVE plan that goes away on July 1st of 2028, but also the pay plan and the ICR plan and
Repay was already rolled up into SAVE, but essentially all of the other. Yeah. Yeah. So pay, ICR, all these other plans are going away, and they want you to switch out of them by July 1st, 2028. Now, what has been proposed and to replace the SAVE plan is the Trump administration's new repayment plan called RAP. What does that stand for, Taylor? RAP? I can't remember. Repayment Assistance Plan? Is that it? Yes,
yes.
that's it. Repayment Assistance Plan is what it's called. So this RAP plan, kind of a cooler name than SAVE, is replacing the SAVE plan. This is their new proposed repayment plan here. This will start July 1st, 2026. As of now, that's what we know. Like they've given us the guidelines and outline of this plan, but you are not eligible to apply for the plan until July 1st of 2026, almost a year from now. Taylor, do you want to go over the details of the RAP plan? I mean, it's very similar to the SAVE
Yeah,
plan.
it's similar to the SAVE plan. I would just say it's kind of a worse version of the SAVE plan. And when I say worse, less favorable to borrowers, right? So currently on the SAVE plan, if you're making a payment and that payment does not cover the interest that you owe every month, that interest is canceled or forgiven, right? That is not changing with the RAP plan. So if you are making a payment with the RAP plan, any unpaid interest will still be canceled or forgiven each month, which is really
Which
good.
is really, yeah, this is the kind of groundbreaking thing about the SAVE plan is if you graduate with $300,000 in student loans and you can't find a way to make those payments, your income is low enough, that loan balance would never balloon when you got, forgiveness 20 or 25 years on. So really groundbreaking. And it looks like, and as of now, they are keeping that interest subsidy for the RAP plan, which is cool.
But the main difference is, right, that's the similarity. The difference is under the SAVE plan, in order to achieve forgiveness, you had to make 25 years worth of payments under IDR plans, which is 300 payments, right? With the new RAP plan, you have to make 30 years of payments, which is 360 payments. So essentially, it added 5 years or 60 payments that you have to make in order to achieve forgiveness. So
That's a long time.
it's like taking out a mortgage, right?
Yeah.
It's a long time to be on an income-driven repayment plan to achieve that forgiveness, right? So that's obviously 5 years more of payments, which is obviously worse. And the other thing that's changed is that the calculation for save of like what payment you had to make was it was 5% of your discretionary income with a more favorable definition of discretionary income for undergrad loans and 10% for grad loans, right?
Yep.
With RAP, the payment is going to be a sliding scale, but as much as 10%, and it will be similarly calculated to the current pay and new IBR plans.
Yeah, but starts at 1% of income and then scales up to 10%. That scale is pretty quickly. It's based on income, whatever percentage you pay. Again, it starts at 1. I think it hits the 10% threshold once you're above $100,000 of income. So again, you hit that 10% fairly quickly. You should expect if you're switching from a SAVE payment to a RAP payment, that it's going to go up. There's a few different reasons for that. I mean, it should go up. Again, this is very broad general numbers, but about 20, 25% I'm seeing in most cases the change from a SAVE plan payment to a wrap plan payment. The reason for this is the city plan had like a 35,000 or $45,000 cost of living exclusion and different things there. The wrap does not include any of that. Another key change with the repayment calculation for wrap is you will never have a $0 a month payment. They are making any minimum payment is going to be $10 a month. Not a huge deal, but that's just something like some people got away with the $0 a month payment. It's nice to just never have to think about it. Under wrap, that won't happen. You at least have to pay $10 a month is the other small change
Yeah.
there.
And that's really the gist of the wrap plan. Not a lot more there. That new borrowers can start applying and change to that July 1st of 2026. So you've got a year to be able to change to that. And then the other key date to remember with all of this is, as Jake mentioned, that July 1st of 2028. So technically, if you don't want to change to wrap or another plan by August 1st, right, you can stay on save and or pay up until July 1st of 2028. But after 2028, your only option will be this new wrap plan or the new and old IBR plans.
Yeah, let's get it. I think we should get into the IBR plan details here. I feel like we made fun of the acronyms before. I really feel like they should change the IBR acronym because all of these plans they're called income-based repayment plans, and they named one of the plans inside that purview income-based repayment, like IBR. Like
So
most people refer,
technically the umbrella for all of these plans is IDR. D
but
is
no
in,
one says that. No one says that.
but that's the real term, IDR, and then they made a plan name that's called IBR, and then everybody uses them interchangeably, and it gets confusing and mixed up. So IDR, D as in dog, is the umbrella where, if you're on any plan, you're accruing credit under the IDR plans. IBR, B as in boy, right? That is an actual plan with specific features and deadlines and it's an actual plan.
Yeah. So let's get into the IBR details. We need to give a refresher on that. And then we'll get into after that for the people who are waiting, kind of how to choose between these plans and what makes the most sense for you and the different things to consider. So we just defined the wrap plan. Let's quickly define the IBR plan. This is a plan that's been around for a while now. Was it? Is it 2014? Is when it was first the new IBR implemented, or
2014 is the new IBR, and 2009, I want to say, is the old
okay.
IBR.
Okay. So after July 1st, 2026, again, under this new bill, there will be two plans available to you. The wrap plan that we just talked about, and then this IBR plan that you can, two different types of income-based repayment plans that you can apply for and get into. How the IBR plan differs from the wrap plan is the first thing is you do not get any interest subsidy under this plan, right? So if you're making payments every month that do not cover your interest that you owe for the month, that amount will accrue on your loans every single month, over the course of a year and add on to that there. So that's the key thing to distinguish there.
Which is a
The
big
other,
a big thing, right?
yeah,
It's a key, and the biggest difference between these plans is, if you are just getting started, right? And our listeners are primarily dentists, right? So the average dentist is going to have 350,000 of student debt. So as you're starting out school, you're going to owe $1,700 a month in interest, right? And if your payment as you get started is zero, right, or close to it, under wrap and save, you'd have $1,700 of interest cancellation, right? And under IBR, right, you'd have $1,700 being added each month to your loan balance.
yep. So maybe people may be thinking out there, oh, why in the world would I want to choose the IBR plan? Why wouldn't I go for the wrap plan? The key is some of these forgiveness timelines and how they're calculated. So again, another difference between IBR and wrap is that the forgiveness timeline for IBR plans is either 20 years or 25 years. So different from the 30. The distinguishing factor, this is a big key thing to remember. This is what me and Taylor go through with clients all the time. There's a big distinguishing factor between the 20 years or the 25 years. And it all depends on when you took out your federal student loans. The date is July 1st, 2014. That's the one that you need to know and to remember. If you were a new borrower, meaning you didn't have any debt, any federal debt, and you took out loans after July 1st, 2014, they will put you in what's called new IBR. You were considered a new borrower. And then under the new borrowers, you get the 20-year forgiveness timeline. If you had any outstanding debt, this includes undergrad loans or graduate loans or anything that you took out before July 1st, 2014, you are then placed into the old IBR plan and have the 25-year, sorry, I can't talk, 25-year forgiveness timeline instead of the 20-year forgiveness timeline. Also, on top of that, if you are a new IBR borrower, which is any loans taken out after July 1st, 2014, they calculate your payment based on 10% of discretionary income. If you are an old IBR borrower, they calculate your monthly payments based on 15% of your discretionary income. So in short, Taylor, the old IBR is far worse plan than the new IBR plan.
Yes. Yep. Yeah.
That's the bottom line.
It's the bottom line, and honestly, if you're gonna be on that old IBR plan, there's probably a much better and more of a chance that you're gonna be on that wrap plan than if you are on the new IBR. And so, as Jake mentioned, just to reiterate and re-highlight, because we're using a lot of numbers, a lot of dates, right? So July 1st, if it's not already like National Student Debt Day, it should be changed to that because July 1st seems to be the important deadline here.
Mhm.
So July 1st of 2014, if you took out any federal debt, both undergrad or graduate, prior to July 1st of 2014, then you are on the old IBR plan. And that means that being on IBR, you have a 25-year forgiveness and your payment is going to be 50% more than it would be under the new IBR.
Yep. So those are the two plans. After July 1st, 2026, again, we kind of, I guess you could say three plans if you want to distinguish between new IBR and old IBR, but it's kind of under the same thing. But the IBR wrap will be the two plans after July 1st, 2026. If you are already on Save or Pay or ICR or any other plan that you've been grandfathered in over the past couple of years, you can still stay on that plan up until July 1st, 2028. And then they will, as of now, what they're telling us is they will require you to switch into another plan or to maybe privately refinance or do something else with your loans. Anything else, Taylor, on kind of details of the repayment plans? Did we hit on everything?
The only like caveat I would say here, because if you're listening to this and like, oh, I took out an undergrad loan in 2013 or 2012, so I must be on the old IBR. If you paid off that loan balance, let's say you took out a small undergrad loan and paid it off before July 1st of 2014 and then went to dental school after and took out new loans, technically you could still qualify for new IBR, right? So that's just a little caveat that I want listeners to be aware of if they're trying to do this on their own and calculate it. If you had zero loan balance, right, prior to July 1st of 2014, then you can still qualify for new IBR. You may have taken out a loan prior to 2014. If you got it paid off before July 1st, then you could still qualify. But if you had an existing loan balance of any form, grad or graduate, prior to that 2014, you are on your only choice of IBR is the old IBR plan.
Yep. Great caveat there. Okay, let's switch gears a tad here, Taylor. Really just go back to the August 1st deadline that we were talking about with the save plan. Now that we kind of defined the new plans available here. So part of the reason we're hopping on this podcast is recently, I don't know if this was yesterday, Taylor, or today, this August 1st deadline came up. Do you give us the backstory, if you know it, just briefly, of courts fighting? There was a safe forbearance plan. Just give us the backstory of this August 1st deadline and what's happening here.
Well, the backstory goes back to Texas, right?
Okay, yeah.
So there was a court case in Texas that blocked number one, the $10,000 forgiveness way back when we were all excited about potentially getting a $10,000.
Oh, yeah, I've already forgotten about that by now, but I remember.
That was blocked by a court case in Texas, right? And then there was the SAVE plan, right? And then another court case from Texas came and found the interest subsidy of that interest being forgiven on the unpaid interest being forgiven to be illegal, right? And so it's been blocked by this Texas court case and it put the SAVE plan in forbearance, right? And that's what Jake mentioned at the top of the pod, right? Where since June of 2024, probably haven't been making any payment and you've been accruing zero interest under the SAVE plan, right? We've been waiting and just in a holding pattern since then, right? And there's been very little updates, if any, other than like, we won't know anything until later. And then all of a sudden, from one day to the next, we get an update that says, "Oh, we've changed our minds." Right? Actually, interest is going to start accruing under save starting August 1st.
Yeah, so me and you have looked into this. We've read a lot of online articles. We've been scouring the internet, right? Doing chat GPT, right? The whole thing trying to figure out, okay, what does this mean and how does this change things? As far as we know, as of now, so interest will start accruing that August 1st date. Even if you're on the save plan. So again, this save plan was initially the safe haven where, hey, I can be on this plan and no interest is going to accrue. It's great. It buys me some time. Apparently that is ending. So even if you are still on the save plan, and when you signed up, they said that interest would be covered every month if you're not paying it. That is going away. So they're effectively changing the save plan, saying it's not right. We're not going to waive your interest every month. So August 1st, interest will start accruing for everyone who is on the save plan.
And this is my initial reaction to this was, okay, well, that's fine, right? Interest technically already was accruing when it was in place, but what was happening was the unpaid interest was being canceled. So it would accrue for the month, and then whatever was unpaid was canceled. So when I first heard this, I say, okay, so does this just mean interest is starting again, but it's going to be canceled? But as you look into it, that's not what's happening. The court case is still blocking that interest being forgiven. So what's happening, you could still be on the save plan and you could still have that zero payment that you potentially had, but interest will now accrue, right? So in that example of, the average dentist with 350,000 in student debt that owes $1,700 a month in interest, now that unpaid 1,700 will be added to your loan balance, right? So you're going to start to see your loans balloon staying on save.
So this is a big change. I mean, at that point, and that save plan interest subsidy is not helping you. So this may cause some people to look elsewhere. Okay, well, what do I need to do with my loans here? Again, as of now, this August 1st deadline is not changing people's income recertification dates is something we need to bring up here too, which is so as you know, when you're on an income-based repayment plan, when you get on, typically in a normal regime or time period, every single year you would have to recertify your income, which would update the amount of payments you're paying. This 1 year recertification deal has been like thrown awry. It's just not been happening over the past couple of years. A lot of people just had the recertification dates pushed. I know a lot of borrowers and dentists who have recertification dates for fall of 2026 seems to be the common thing. Either it's this fall or maybe it was pushed to fall of 2026. Whatever your recertification date is, when you go to your servicer and you go to your website, it should tell you here's when you're going to have to update your income for your student loans. Those dates have not changed as of yet. So if you were on the SAVE plan and you had a recertification date of, let's say, August of 2026, what would happen is starting August 1st, interest will start accruing on your loans, but you still are not put into default. Like your payments are still 0 or 50 or 100, whatever your payments were before, you're still there, right? You still have $0 payments, but interest is accruing now on your loans until that August 2026 recertification date for your income.
And this is a really important point that you're bringing up here, Jake, because I think when people hear interest is going to start accruing, right, and they're like, I don't like that, right? I don't want my loan balance to balloon, right? So I think initially when you hear that, the immediate reaction is, well, I should switch plans, right? I should switch plans and I should get to a new plan. The problem here is that recertification, right? And this would be the case if we're trying to answer the question, what should I do with my student debt, right? If I'm answering, I'm on save, I haven't had to make a payment for as much as 5 years now, right? I've done nothing but get zero payment, interest free loans. The piper's calling, right? And now I got to start making a payment, right? So my initial gut reaction is going to be, I should switch to a different plan, right? And my response to that would say, maybe, right? You might want to. And the reason is this recertification of income. Because right now, as Jake mentioned, most people will not have to recertify until the fall of 2026.
And most people, there are plenty of dentists and borrowers who have not had to recertify their income for years, I think is the key thing here. So we know people who maybe had to submit their income when they first got on the income-based repayment plan or when they first got on to save. Let's say that was 2021 or 2020 or one of these dates, and their servicer has not asked them to resubmit their income for years now. And so when their first income was resubmitted, let's say that that's when they first graduated or first got into practice ownership, Maybe they have a really low payment. Maybe you were paying $100 a month or $50 a month or $0 a month.
The vast majority, as you're pointing out here, they they submitted their income when they were a student, which was 0, right?
Yeah.
So they had a 0 income that they were submitting, right? Which is why a good majority of people on Save have had a 0 payment because they're submitting their student income that they had, or even their first half year of income, which might be 100 grand or less, right? So that's why a lot of people right now under the Save plan have a small income. And so if you make the decision, the gut reaction to go out and change plans, the problem is you have to recertify your income, even if it's not your recertification month. And if it's been 5, 6 years since you've recertified your income, chances are your income's gone up a little, it has gone up a little bit since when you were a student.
And yeah, again, from 0, again, if you're making, let's say 300, 400,000, whatever it may be, and you have to recertify that income, your payment could jump from 0 or $100 up to $3,000 or $4,000 a month. And so that's a big consideration. This is where, like, what should I do with my student debt? This is very much an it depends answer. This is a personal financial planning question. If you has been an advisor, someone you could talk to, reach out to them and figure out what makes sense for your situation. So if you're like, hey, I'm on the Save plan, interest accruing on my loans does not sound great. I do not want to sign up for that. I want to switch to, really the only thing you can't switch to now is IBR, right, Taylor? I know
Technically,
we've looked and we've seen people can do pay still.
technically you can switch to pay, but you're switching to pay, which then you can only stay on until 2028.
Yeah, weird. Yeah, pay's still around, which yeah, you can be on for a couple of years and that goes away. But if you're switching to IBR, you're like, okay, I'm not accruing interest. That doesn't sound great to me, but you are going to have to increase the amount you are paying per month for your student loans. And so becomes a budget question, right? This is where we have to dive into what is your income, what are you paying in taxes, what is your current debt rate between mortgage or practice loans or different things there. What are you currently spending? How much are you saving? Right? This decision involves all of those aspects. That's the one thing you need to. People need to start doing these calculations for themselves. Is okay. Do I want to stay on the save plan? Because maybe again, interest accruing doesn't sound great. But the reason these income-based repayment plans exist is to give people flexibility until they can get into their career, get their feet underneath them, start making a good income. So if you're still in that position where you're like, hey, I don't have 2 grand a month or 3 grand a month to pay towards these student loans, I need the flexibility to either invest in other areas of my life, invest to a practice, whatever it may be. Maybe it makes sense to stay on the safe plan, keep a low payment, and even though interest is accruing, that's just the price you're going to have to pay to make your budget work for the time being, right? So the
And
plan isn't just like, let's jump off the save
common
plan.
this is probably gonna be more common than, people care to admit. Like, just from a cash flow perspective, hopefully, over the last 5 years, you have taken that and, 0 student loan payment, and you've been saving more money and investing more money and putting money away in different areas, but I suspect that there's been a lot of people who have taken that 0 student loan payment and have just increased their lifestyle and are spending more. And they may not have the flexibility of just adjusting an auto draft, right? And the other situation, which I literally got off a phone call with a client who's in this situation half hour before this podcast, is he's doing a startup this year, right? And he is okay with the interest accruing because he needs a really low payment on his student debt so that he can give himself a runway with his startup practice. So just to echo, and I feel like all I've done is echo what Jake's saying because Jake's a great advisor. But to reiterate what he's saying here is like cash flow is everything in this decision. It's okay to stay on save if you need a couple more months to figure out cash flow before you jump up to a two, three, four, $5,000 a month payment.
If you're thinking, I just want to put in here, if you're thinking at home, if you're listening to this and thinking, wait, okay, I'm on the save plan. They're making me have interest starting to accrue on August 1st, but they're not offering an alternative plan until July 1st, 2026. What is up with that? I agree with you. I have no idea. Like, don't quite understand why we're starting interest payments and they're not offering an alternative interest subsidy plan until July. That's tough. Like, we're going to be in a weird in between period over the next 12 months with that. And so, yeah, ideally, like, if you want to stay on the safe plan, maybe interest is going to accrue for the next 10 or 12 months. As of now, though, there will be an alternative wrap plan that you can get on. If you still need cash flow help, you can then apply for that next July, get the interest subsidy, and stay there again. We're just in a weird period over these next 12 months, apparently, where they might have some interest accrual before this new plan comes into play. So it's
And I
interesting.
think I think that's an important distinction here as again, Jake, is when you're doing your calculations here and you're figuring out what your income driven repayment plan or your shouldn't say income driven, your income based repayment would be, right? If that amount is still under your interest owed on the loans, then under wrap, you will be getting an interest subsidy, right? So there's a high likelihood that a year from now, you will switch to the wrap plan. But if you do the math and it just so happens that your income based repayment is going to be above and beyond what you owe in interest every month, you're not going to choose the wrap even when it comes available a year from now. Right. And so to me, that's kind of the threshold. If you're going to stay on an income driven repayment plan, either wrap or IBR, you really need to calculate what would my new payment be under this income driven repayment. And then is that covering my interest owed every month or not? If it's not, you're probably going to want to wait around and switch to wrap. If it is, there's not a lot of sense in waiting because you're going to be covering the interest owed anyways.
Yeah. And that's great point, Taylor, for again the people who are listening. If you're wanting to do some quick calculations in your mind without going to like an online student loan breakdown calculator, or if you're going to studentaid.gov to figure out what your calculations would be, if you are at a 1.5 to 1 debt to income ratio, or like getting close to a 1 to 1 debt to income ratio. So that means is, let's say you have $300,000 worth of student debt, but you make $300,000 in gross income. Usually when you're at that 1 to 1 ratio, you are not like, even under a wrap or save or one of these interest subsidy plans, you're not getting any help from the government when you're at that income to student debt level. So that's some quick math you can do in your mind is if you're approaching 1 to 1, 1.5 to 1 debt to income ratio, you're probably not getting any help.
And to clarify that, that's the assumption that you are only a few years into these income driven repayment plans, right? If you're already 10, 15 years into the repayment plans and you're approaching 1 to 1 for the first time, there still may be a sense that you finish it out and go for that loan
Yeah.
forgiveness. But if you're relatively new to the income driven repayment umbrella and you don't have a lot of payments under your belt and you're already at that 1 to 1 ratio, you're probably just going to be better off doing a private refinance.
Yeah, that's our third option that we haven't talked about here, kind of with everyone is you can privately refinance your student loans. That has not been a very common thing to do over the past couple of years, but that is kind of the traditional way. If you are at the like 1 to 1 debt to income ratio earlier on in your career, you're not getting any help from the government. You have enough cash flow where you can afford to pay off your loans. Oftentimes, it makes sense to do a private refinance, try and get a lower interest rate than you have with all of your different tranches with the government and pay back your loans over a fixed time period, right? Whether it's 5 years or 10 years or 15 or 20. Most of these, you can do private refinances up to 20 years. Is usually they'll let you extend it out that long. Just some quick details on privately refinancing. It's a really competitive space. So there are options. There are a lot of different companies online you can go with, which is like Laurel Road and Citizens Bank and SoFi. I'm missing a few, like Advantage is one. Earnest is one, right? There's a lot of different companies. They're all really competitive. When you're refinancing your student loans, there's typically no cost to refinance, right? There's no upfront cost. Like if you're refinancing a house or getting a loan for a house, there's closing costs and different things or down payments you may have to come up with. That is not the case for student loans. It is free to get in. And so what that means is, I mean, right now, rates are around 5.5 to 6% is what we're seeing in today's environment for refinancing your loans. If rates ever drop in the future, you can refinance to a better rate without any cost to you. So you don't need to worry a ton about the interest rate now. You can always, if and when rates drop, you can do it that way there. But that is the option of, okay, well, I don't really want to be on income-based repayment plans anymore. I'm making enough income. It probably makes sense for me to pay these back. You can do a private refinance and just knock those things out.
Yeah. And it feels like it's been a long time, but honestly, this was the most common path for dentists,
Yeah.
right?
Yeah.
Prior to 2020, it
Yeah.
was be on an income driven repayment plan for a couple years, get your income up to a point where you're making good money, and then you do a private refinance and put them on a 20-year frame where you're at least paying them off in 20 years, if not sooner, as you know, extra cash flow allows. this prior to 2020 was the most common student loan path. It hasn't been because we've had this just incredible interest subsidy. Like, if you're a dentist, you've already won the lottery just having student debt at this time. Jake and I were going through the calculations before this pod. In some instances, it's hundreds of thousands of dollars of interest savings and just cash flow payment savings that you've had over the last 5 years.
Yeah.
So,
If you're feeling a bit bitter right now, if you're listening to this and you're like, dang, I mean, I thought I had more runway. I thought we were just going to keep deferring loans for forever, get some sort of forgiveness. Like I was really banking on the government helping me out here. Where I would point your direction to a more optimistic point of view would be you have had 4 to 5 years, again, depending on when you graduated and things like that. But for people who are graduating, before 2020, you've had 4 to 5 years of not having to make any payments on your loans, not accruing any interest, which has allowed you to invest in other areas of your life, invest back in the practice, save up cash, get money in the stock market. You are coming out ahead here. It has helped you get established these past couple of years. And so that's the optimistic, that's the way I would look at it. If you're feeling bitter or kind of sad about this, like I would look at, I've kind of had a pretty good deal these past couple of years. And it seems like that's coming to an end. But that's okay.
yeah.
It's just
And
fine.
when you took out the student loans, you fully anticipated that you were going to have to pay them back eventually, right? There was no expectation when you eventually took these out that, like, I'll never have to pay these off and I'll
I
just
don't know.
get.
I think I've had some people think that. I honestly think some people have been like, you know what? It's happened for 5 years. Can we just keep pushing this?
Yeah, but that's been the sentiment as they've gotten it. But no one, when they took it out, was like, I'm never going to have to pay this off, right? And this is just free money, right? And we've been given a great, like, blessing, if you want to call it that, right? Of a ton, I mean, tens of thousands, if not hundreds of thousands of dollars in interest savings and cash flow over the last 5 years for all of our clients that have student debt. And, now you got to start making a payment, and it stings a little bit, but you can always look at the negative or the positive side. And it's been a really, really great benefit for anybody with student debt over the last 5 years.
Okay, Taylor, have we missed anything? I'm trying to rack my brain to see if we've covered it. Was there anything we've missed?
I'm sure we have. I'm sure there's a lot that we've missed, and there's even more fine print and details that's yet to come.
I want to emphasize that again. Everything we've talked about today honestly could change in like a month from now. So just be careful. We will keep you updated, but this is a moving target. We are in the early days of figuring all this out.
But I would say if you are listening to this and you're like, I tried to follow what they were saying, but I'm completely lost and my head spinning, please reach out, right? We assume that a lot of the people listening are clients of ours. So please reach out if you're confused or have questions of what you need to do between now and August 1st. That's what we're here for. And if you're not a client and you want to talk to us, we have go to dentistadvisors.com. There's a big button, I think, in the upper right hand corner that says book free consultation. All of our advisors are very well versed when it comes to student loans, regardless of who you get. You're going to be able to find and talk to somebody you can, at least point you in the right direction when it comes to your student debt.
Very good. Yeah, huge point there. Do we want to end with there was a other like this bill did introduce caps on federal student loan lending, which doesn't quite apply to like our clients and who've already taken out debt and things. But I do wonder if people have questions about it. Uh,
Student listeners, obviously, this is going to apply to them, and it's going to apply to, we got a lot of clients who are having kids and saving for their kids' colleges. And, hey, maybe 5 times are more attractive than they once were. I've personally been of the mindset, like, take care of your own retirement first and have more flexibility with a brokerage. But if the current, you know, triple B, one big beautiful bill stipulations hold up and it doesn't change, college is going to get a lot more expensive and come a lot more out of pocket than it once did. Right.
yeah,
So I,
so
I
just
think it's worth mentioning.
yeah, to give a quick overview here. So as part of this bill, there's like they've introduced new federal student loan caps, and so they're capping the amount of federal student loans you can take out to pay for school. Just for so in general, this is the crazy one. Undergrad debt, there's like different, they've capped like undergrad versus professional versus medical type of debt that you can take out. For undergrad debt, they capped it at 57,500 is the current cap, like total amount of undergrad debt that you can take out. professional, like medical, dental school, they capped it at $200,000. And so combined, you could have about 257,000 total, right? If you're doing the math there. Uh, that's not a lot. That's a pretty low cap. I mean, we don't need to throw any schools under the bus here. But there are a lot of dental schools that cost a lot more than $200,000 for a full 4 years. And so this, again, we do not know how this is going to play out, what the trickle down of this would be. On one end, you can say, okay, well, I'll take out as much federal debt as they'll give me. And then I'm going to have to go to private lending for the other part of it, or I'm going to have to reach out to a family member to help pay for other things. Or maybe in the rosiest, best future, this helps curb some tuition spending and tuition actually comes down. I'm
Yeah,
skeptical of that, Taylor.
some people that think that it's gonna close down some of the more expensive colleges, and then there's gonna be less openings for degrees, and then those degrees will be more competitive. There are so many repercussions and implications that could potentially happen, and the honest truth of it is anybody who's opining on this doesn't know and is
Yeah, we
just,
don't know.
you know, they're just making conjectures based on what's in front of them. But we don't know, but it's gonna change. It's gonna be, depending on how long this lasts. That's the other thing is, like, some people are saying, "Great, this all happens until 2028," and that's right when, Trump gets out of office, and there'll be another president, and they may change everything when they come into office. We don't know. We don't
I
know
want
the
to say,
we don't know the details. At least in the short term, interest is starting to accrue, and you're gonna have to start making payments.
yeah, I want to say one thing to your last point there, which is when you take out your student loans or when you're trying to create a plan for yourself and what makes the most sense over time, it's really hard to depend on these government programs, I think, in the long run, just based on the pure fact that they're going to change all the time and with different administrations. I mean, think how much has changed with student loans over the past 5 years or the last 7 years. And so I would be wary of that just as you're going through and like, I'm going to maybe depend on this long term forgiveness or not, or whatever that may be. It's tough. Things could change all the time. Every couple of years, all of this stuff could change again. And we might be doing another emergency podcast in a couple of years with new changes. So keep that in mind. Yeah, things are changing all the time.
Yeah, it'll be interesting to see, to Jake's point, 2009 was the first income-driven repayment plan, right? So if you took out a loan in 2009 and then started the repayment, which would be the earliest that you could have done something like this, right? That means you would hit the 20-year mark in 2029, right? So the first forgiveness, if you were on pay, would be 2029. Unfortunately, if you took out that loan in 2009, technically you'd have to be moved to the old IBR, which is now a 25-year loan forgiveness, which means that the earliest that we could start seeing any forgiveness for any loans is now going to be 2034. So to Jake's point, we don't even know. We haven't seen forgiveness ever happen. And the earliest now that we could possibly feasibly see it outside of the 10-year PSLF is going to be 2034.
Which if you've made we probably should have brought up PSLF earlier. If you've made it to minute 45 of this podcast, the public student loan forgiveness, the 10 years that gets waived if you work for a nonprofit or the government or specific industries, it's still in place. So that hasn't gone away. The 10-year public student loan forgiveness is still there. My guess is people were probably nervous about that. We probably should have said that at the top of the pod. But if you've made it to minute 45, there you go. PSLF is still in
And we're
play.
going to have a lot more content and things coming out as we get more details. Again, the purpose of this particular podcast was to help anybody who is on Save and is worried. I've had a free ride for the last 5 years. Now I have 21 days to make a decision what I'm going to do. Right. Our hope is that this gives you a little bit more insight and a little bit more direction as to what you should do with that decision.
Yes, I think let's wrap it up there. We can stop rambling here. I think we've hit on most of it. I have a Superman movie to go watch tonight. Taylor, what do you think? Do you think it's going to be good? Have you seen any trailers? Do you know anything about it?
I know nothing about it. I think
Okay.
any Superman movie, you're fighting an uphill battle. But I really liked Guardians of the Galaxy, and James Gunn was the
Oh, James
director of
Gunn
those
guy.
movies,
Yep.
and he's the one that's directing the Superman movie. So I'm cautiously optimistic.
Yeah, I am too. I think it's going to be fun. Anyway, okay. Thank you everyone for listening. Again, reach out to an advisor if you have questions, or if you are not one of our clients, go to our website. You can book a consultation. We'd be happy to point you in the right direction. That is all from us tonight. And we will see you next week on the podcast. Talk to you later. Bye.